Coming up in today's show, stocks finish up for the third week in a row on the back of more cooling inflation data. Consumer sentiment climbs again in July. What historically happens after a good month in July. Gold trades up to $2,000 an ounce. And why this billionaire has all his money outside the States. Welcome back to the Click Capital Daily Show, everybody. I hope you're having a great start to your weekend. And it was a good finish to the week on Wall Street, with megacap tech and Nasdaq leading the way, and pretty mixed throughout the rest of the market there. And since it's the end of the week, here's a look at the end of week performance across the heat map. We can see Google and Meta had great weeks, both up over 10%. And once again, it's pretty mixed out there, getting through Q2 earnings season with blotches of green and red across the market. It was only really REITs and utilities we saw some bearish breadth in. And so the market no doubt loved the news that we got today of the personal consumption expenditures PCE index grew 3% year over year in June, down 3.8% the month prior, and came in line with expectations. Core PCE, which excludes food and energy, grew 4.1%. Down from 4.6% the month prior, and a little bit below 4.2% expectation. And core PCE is the one that Jay Powell talks about a lot and is still saying it's well above their longer run goal of 2%. And there's a look at a chart of the last couple of years of the PCE indices. And ever since they climbed up in 21, they've stayed relatively elevated. We have been ticking down this year, helping the stock market getting excited. However, for this stock market rally to really sustain itself, we really need to see this and other inflation data continue to trek down towards 2%. But like I said yesterday, keep an eye on commodities for some clues on where inflation could be going next, as commodities are a big cost input into just about everything in our economy. Not just energy and transport, but also the production of goods and operation of services. And so this is a line chart of the commodity index ETF DBC. And we're just looking at the weekly chart here going back to 2019. And we can see it sold off a bit here in COVID, then bottomed out and ripped up quite hard, then peaked out in May last year and has been tracking down ever since. However, we've broken out a bit here, and it's possible this uptrend may resume. We're breaking out a bit of a trend line here, and I'll just overlay this chart with the core inflation rate that we can see here in the orange line. And we can see there's quite a bit of correlation between the price of commodities and inflation, just like I talked about. And so inflation topped out about the same time commodities did. But remember, this inflation data is a bit lagging. And so looking at the price action, the hard right edge of the chart in commodities is more of a leading indicator. And so that's been ticking up the last couple of weeks, especially in the price of crude, which has had a nice little bounce and finished today over $80 a barrel, and also the price of agricultural commodities, which has a huge effect on the price of food we all need to pay. And that's coming back up to those early 2022 highs. So with a tight jobs market and everyone spending, and if we continue to see an uptrend in the price of commodities, it's hard to see this orange line, core inflation, keep going the other way and create too big of a divergence. Because just looking at a long-term chart of the core inflation rate, back in the late 1960s, it was increasing going into the 70s and hit a similar level that we got to last year and came off and decreased in a similar pattern that we're in now. However, that wasn't the end of it. It ended up swinging up to over 11.5% a few years later, then swinging down for another couple of years before swinging up to its final high, a bit above 13.5% in the early 80s, before it finally came down into the early 80s, back down to target around 3%. And for those of you old enough to remember what interest rates were like back then, you can remember they were a lot more higher than they are today. And so we've already got problems out there with banks and consumer debt being stretched, with the Fed funds rate at 5.25%. However, I'll just overlay this chart here with what the Fed funds rate was back in the 70s. You can see it correlates really well with inflation, as central banks will increase the cost of money to try and cool the economy and cool inflation. And interest rates in the late 70s going into the early 80s, when inflation was peaking, were above 15-17%, with mortgages at 20%. So the way the stock market is trading there, it's really hoping inflation is going to do this and just fall right down to target and stay there, whilst AI continues to help corporate profits and expand operating margins. However, the stock market really doesn't want inflation to swing back higher and catch a lot of people by surprise. And that's why I say keep an eye on commodities, because commodities were also ripping higher in the 70s, and it has a big influence on inflation rates. However, for now, we still have near record low unemployment rate, and most consumers still have cash to burn, and that's why we're seeing the consumer sentiment survey continue to tick higher, coming in at 71.6 in July, climbing from 64.4 in June. And you can probably still see that yourself when you go out to restaurants. Events and concerts are still really busy with a lot of people, and we can see that in Live Nation sales, with their second quarter revenue jumping 27%. With one research analyst saying no recession here, Live Nation continues to benefit from record artist supply, strong consumer demand, venue and global footprint growth, with management continuing to see record demand globally and no sign of the consumer pulling back. And just looking at the chart of Live Nation today, they did come in with a huge beat, reporting quarterly earnings at $1.02 per share, 57% higher than the estimate. However, we sold off hard today because we did get news that the Department of Justice could file an antitrust lawsuit against Live Nation, accusing them of some monopolistic and abusive pricing behavior, which could have a bit of effect on their business. And so it looks like that news overwhelmed the great quarter they had and future guidance as well. And so it's the end of the month on Monday, and we've had a pretty good month in the stock market with S&P 500, NASDAQ, and Dow Jones all up about 3% month to date. So here we'll just take a look at what happens to stocks for the rest of the year when we up 10% or more through to July. And so the S&P 500, the average return July to December will be 4.8%. with a huge 95% of the sample positive, and the Nasdaq coming in with a higher average return 6.3%, but a bit lower positive readings at 69%. So just like the January effect, when we have a good January, that can lead to a good rest of the year. That's played out, and it looks like we may play it out again with the July pattern. But like I said, the only thing that could really upset that is CPI and inflation data coming in hotter than expected, because we've been having a good Q2 earnings season, which is helping keep things bubbling along. But just keep an eye on the price you pay for your gas, because we've got interest rates on the march higher. Consumers have $1 trillion in credit card debt. They're also spending 40% of their average income on housing costs. And because crude has dropped a lot in the last year, falling from $120 a barrel down to the mid-60s, that's helped the consumer a lot. However, if that were to start ticking back up and trending back the other way, that should have an effect on inflation and consumer discretionary spending. And if inflation does tick back up, a good place to hide out and have a portion of your overall portfolio invested in is that of gold, which performed really well in the 1970s with that huge inflation I showed you. And the good thing about this shiny metal is that humans have used it to transact and store wealth for 6,000 years. And there's only a finite amount of this stuff in the world. Apparently all the gold in the world can fit inside an Olympic-sized swimming pool. And the good thing, and what I really love about gold, is it's priced in US dollars. And thanks to the Federal Reserve, there's an infinite amount of US dollars and always will be. And that to me gives a strong structural tailwind to the price of gold. And as I've been saying for a while now, it's creeping back up towards these all-time highs, just under $2,000 an ounce. And just taking you out to a monthly chart here. All-time highs at $2,089 an ounce reached in August 2020. And in my opinion, at some point over the next couple of weeks or so, we're going to break out to all-time highs above 2,100. And we could go on another run, similar to the first one we had from November. And if I just do a Fibonacci extension on that first run, 50% would take us to 23, 61% would take us to almost 24. And if we do the same size move again, we'll be getting up above 2,500 an ounce. And for the most part, investors have historically low allocations to gold. And if we see inflation tick up and a bit of an exodus out of stocks, a lot of people might start looking to gold as a place to put a bit more of their money, and that could exacerbate an uptrend. And so I wouldn't be surprised if we do hit that 2,500 by Christmas or going into early next year. We've got billionaire hedge fund manager Mark Mobius saying he's very bullish on emerging markets, so much so he has all of his money outside the States and focusing his investments in Taiwan, South Korea and India. He's more cautious on China, saying the world's second largest economy is still going through a tremendous adjustment that will make it very difficult for many companies. He believes tensions between China and Taiwan are unlikely to boil over anytime soon. And he's getting more bullish on India as companies like Apple are shifting towards India in order to diversify their business away from China. And maybe he's right, because here's a long-term chart of the S&P 500. And you can see from when we bottomed in March 2009, we're up almost 600% to where we are now. However, from that same point in emerging markets, we're only up 120%. So emerging markets have significantly underperformed the States over the last 15 years. And so whilst it's technically and fundamentally a lot cheaper when you look at valuation metrics, for a lot of people, they call emerging markets just a trade and uninvestable. So it'll be interesting to see over the next decade or so whether emerging markets can catch up to the States or not. Here's a quick look at some economic data we got out from around the globe today. Japan kept their interest rates at minus 0.1%. Aussie retail sales contracted 0.8%. We've got France's GDP coming in at 0.9% year over year. Their inflation at 4.3%. Spain's GDP coming in at 1.8% year over year. Their inflation a bit lower at 2.3%. Germany's GDP coming in at negative 0.2% year over year, showing the economy still slightly in a technical recession. And their inflation rate still pretty high, 6.2% year over year. So it looks like Germany is already in a stagflation scenario. stagnating economic growth and high inflation, which is typically not a good combination for risk assets. There's that PCE data we got in from the States, and personal spending month over month up 0.5%. And there's that consumer sentiment coming in a little lower than expected, but still an increase on last month. And just looking at next week, we got some PMIs coming out of China on Monday, a few more retail sales and GDP numbers from Europe, and then the Eurozone GDP and inflation, with some more PMIs from across the globe, and the big one will be on Friday with the non-farm payrolls coming out of the States. With no surprises coming in on that PCE data, markets slightly cooled their probabilities the Fed will hike to 20% in September, but still an almost 1 in 3 chance they'll have it done by November. No surprise from the Fear and Greed Index, still in the extreme greed zone. And another typical Friday in the options market, almost 47 million contracts traded, 56% of them calls. Dark pool traders still not showing much interest in this market. And yesterday there was only 16 purchases of stock by company insiders, and that's the third lowest reading we've had in the last year. Okay, back into the charts, and so we got a little bit of a bounce here today, which is not all that unusual after yesterday's bearish engulfing pattern. I've seen this happen quite a few times. And if you actually go back to October 13, when the market bottomed out, it was on the exact same pattern. It was a big bullish engulfing pattern. Then we pulled back pretty significantly the next day, closed down 2.4% almost. However, that was the last bottom in the stock market, just below 3,500 in the S&P 500. And we've now rallied up over 1,000 points since then. And so it's still yet to be seen whether this bearish engulfing pattern will play out. For it to be invalidated, which I would put at least a 40% chance on that happening, we'd have to see a solid close above this resistance zone and above 46.50 for us to then say that this bearish engulfing pattern has likely failed. However, if we were to get a close below yesterday's low next week, and furthermore a close below the 50-day VWAP, this white line here, then just maybe the market might have put in a short-term top on the same pattern it put in the last bottom on October 13th last year. And just taking you out to a weekly chart on the SP 500, we can see we're now putting the 5th consecutive reversal signal inside this resistance zone we last turned back in March last year. And we can see we're now in overbought levels on our DSI index. And the last time we were overbought was back in early November 2021 near the top of the market. So technically speaking, we are a bit stretched here. We are technically overbought. And looking at that bearish engulfing pattern on the daily, this could potentially be a top. However, no body and no pattern and no indicator is 100% right all the time. But I'd still put the odds of this playing out at about 55 to 60%. We've got other similar patterns in the other indices like the NASDAQ with some big long bearish divergences forming. The Dow has been strong the last couple of weeks, but that's looking a bit stretched as well. And similar story in mid caps and smalls. Quick look at international stock indices, Canada's TSX, the UK FTSE, the German DAX sitting right at all-time highs. And look at that huge move from the China 50 index. I'll just take you out to a weekly chart here, and if you've been following my channel, you know I've been talking about this squeezing wedge triangle and how it could resolve itself, and it looks like we've got a bit of a clean break to the upside here. After China's stock market has been underperforming the rest of the world pretty significantly now for the last couple of years, and so we're getting this big move up in Chinese stocks because investors are building hopes of a big stimulus package coming out from the CCP ruling party, as their growth has been stumbling, and the CCP's #1 mandate is social stability, and they achieve that through economic growth and keeping everyone employed and happy. And so this move up in Chinese stocks and some policy stimulus is probably what's helping commodities as well. No surprise we got a big fall in the VIX on Friday, making option dealers more money with more contracts expiring worthless. Breadth continues to fall a little bit though, with 63% of stocks above their 20-day average, and the amount of stocks breaking out to new highs continues to track sideways. Growth versus defensive sectors continues to hug its 50-day. Another pop-up in high beta and growth stocks, and small caps continue to hold their ground against the S&P 500. Credit spreads continue to trade optimistically with high-yield bonds tracking up versus treasuries, and a slight little pullback in the 2-year government bond yield today to 4.88. And looking at Fed fund futures for the rest of the year, we've got a bit of a flat curve here, with August at 5.33, September 5.35, and December 5.40. So the bond market's not really sure what the Fed's going to do. We really need to see those CPI reports. If they come in lower than expected, then the Fed might come out and say they're done for now, they're just going to go on pause for a while. And that pause could last a year or two, which could still harm the economy. However, if we get a hotter CPI than expected, then the odds the Fed hikes again could jump to 80-90%. And so stick with me over the next couple of weeks, because I'll be looking for clues on that next CPI print, inflation, and the Fed by looking at the price action in bonds and Fed fund futures. It's a little bounce in TLT trying to hold the support zone. And there's high yield bonds doing a lot better than long dated treasuries. There's a dollar index right back at its 50-day VWAP, and Bitcoin just holding on to its 50-day, but looks to be on a bit of a bear flag here. There's crude in a strong short-term uptrend, closing above $80 a barrel. And over to stock sectors, we've got a nice bounce in the cannabis ETF today, up a bit over 5% from the support level. We'll see whether this can hold and we can get back above a 50-day VWAP. And some nice performances across the board in the growth sectors. We can see semis trading back up to their year-to-date highs. Highly valued stocks doing well, with ARK up 5.4%. IPO market still doing well, up 4% today. Clean energy stocks still in a short-term uptrend. And there's energy and oil and gas stocks starting to do a bit better. And Dow Theory is still saying the market is bullish, with industrials and transports trading near 52-week highs, and a bit more softness in the defensive sectors like utilities actually came off a bit today. And over to stocks we follow, here's BlackRock up a little bit. And we got quarterly earnings out today from the second biggest oil company in the world, ExxonMobil. They came in a little lower than expectations, $1.94 a share versus $2.03 expected, and that's mostly due to that weakness in crude we have been seeing this year. However, that could be the bottom around the mid-60s, and don't forget we saw Warren Buffett loading up on Chevron all throughout here buying the dip. So the world's best stock investor thinks it was a good time to get in on oil, and the next big technical zone we'll be looking at in oil is whether it can break above this $85 a barrel. Bit of a resistance zone, put in a higher high, a higher low, and then we can say we're back into an uptrend in oil. Megacap Tech had a good day. Apple up near its highs, and we got earnings coming out from them next Friday. Little bounce out of Microsoft, still below its 50-day. Google tracking up to new year-to-date highs. NVDA hanging around all-time highs, just below 475. Tesla up 4.2%, trying to hold on to its 50-day. Meta finding new year-to-date highs again. And a pretty good day across the meme stock space, with most of them up over 3, 4, 5%. Active today was the Chinese internet ETF KWeb. Had a really good day, up 7.5% on pretty big volume here, and looks to have broken out above a trend line, and looks like some big institutional money is starting to bet on China again. We also had earnings coming out from Procter & Gamble, came in with a slight beat, market mucked them up almost 3%. Also had earnings out from Roku, they beat significantly by 40%. Market loved that, up over 31%. And really strong beat from Intel yesterday, which caused the stock to go up 6.6% today. And after Enphase's earnings yesterday, we did gap down, but it looks like we may have been dip bought here on a bit of a hammer candle formation. And the regional banks continue to trade well in these short-term uptrends, along with the big guys as well. Charles Schwab pulling back here and defending its really good recent quarterly earnings. Okay, that's a wrap for the week. And so, like I said, the big things going forward to keep an eye on the price of commodities, inflation data, and the price action in bonds and Fed fund futures. Because this stock market's really drunk on the idea that inflation is going to go back down to 2%. Corporate profits should start growing again in the fourth quarter of this year, and they're hoping to go into that Goldilocks scenario, which could still happen, as nobody knows for sure 100% what's going to happen. But that would be in the face of a really aggressive Fed rate hiking cycle. But so far, Q2 earnings are better than expected. The bar was set low, with average earnings expected to decrease 9%. We've currently got about 78% of companies beating, which is about long-term average. And so this short-term strong momentum persists, and we still may make it up to those all-time highs around 4,800 on the S&P 500 before we see this year's correction or pullback, which seasonally speaking normally happens before October over this time of the year. However, like we've seen with that breadth, signals good January, good July, good year-to-date performances, and breadth starting to pick up, that generally bodes well for the rest of the year. But that's all for now. Thanks very much for sticking with me and tuning in every day to the show. Truly appreciate all you guys. I hope you all have a great weekend, and we'll see you again Monday afternoon. Cheers.